IPCC's Climate Finance podcast series, created for institutional investors navigating climate risk. In today's episode, we're looking at the future isn't static SBTi targets. Most transition risk models assume emissions remain constant. This paper tests what happens when we replace that assumption with the decarbonization trajectories companies have already committed to through the Science-Based Targets Initiative. By converting validated targets into forward-looking emissions pathways and integrating them into a scenario-based transition risk framework, we isolate the conditional impact of delivery on transition value at risk and temperature alignment. The question is straightforward. How much portfolio risk changes if companies deliver on their stated commitments? Okay, so let's get into this. We've laid out the basic question from the paper, but before we dive into the results, which are pretty surprising, we have to talk about the way things are usually done. The paper kicks off by pointing out this fundamental flaw in most risk models. They call it the static assumption. What exactly is that, and why is it such a big deal?
It's a big deal because it basically ignores reality. It ignores strategy. When we calculate something like transition value at risk or TVaR, we're trying to place the future. But the standard model for years has been to look at a company's emissions, say for last year, and then just assume they will stay exactly the same forever, out to 2050.
So the model literally assumes the company does nothing. No innovation, no new regulations, no change at all.
Nothing, exactly. It's business as usual in the most literal and I'd say laziest sense. And look, to be fair, it's a conservative baseline if you're looking at a company with no plan. But it creates this huge distortion for any company that's actually trying to decarbonize. It treats the laggards and the leaders exactly the same.
You know, I was trying to come up with an analogy for this, and I kept thinking about a marathon runner.
Oh, I like that. Go on.
Imagine you're at the starting line. The gun goes off, your heart rate spikes to, 160 beats per minute just from the adrenaline.
Right. That's your baseline data.
And a doctor looks at that and says, okay, your heart rate is a 160. So my model predicts it will be 160 for the next 4 hours. It completely ignores their fitness, their training, their pacing strategy, all of it.
That is a perfect analogy. It ignores the plan. And in finance, that static model systematically overstates risk for the companies that have a plan. So if you're an investor, your model might be screaming that these companies are a huge risk, when in reality, if they just execute on their stated goals, that risk, well, it drops dramatically.
So the static model is actually punishing the companies trying to solve the problem because it's only looking in the rearview mirror.
Precisely. It creates a major signal failure in the market. Capital should flow to companies reducing their risk, but the models are muffling that signal. We're missing the transition part of transition risk.
Which brings us to what this white paper actually does. It sets out to break that assumption. It asks, what happens to the numbers if we assume the runner actually sticks to their race plan?
It's such a simple question, but to answer it, you need really specific, really credible data. You can't just rely on a CEO saying, oh, trust us, we'll be green. That's not data.
Right. And that's the next piece, the data foundation. Yeah. Garbage in, garbage out, right? So the paper leans entirely on the Science-Based Targets Initiative, SBTi. Why them? What makes their data the gold standard here?
Because talk is cheap. An annual report can say anything. SBTi is a validation body. Companies submit their targets, and SBTi's job is to verify that those targets actually line up with the Paris Agreement. Are they on a path to limit warming to 1.5 degrees? It's independent. It's rigorous. It's the best source of intent we have.
Okay, but even with SBTi, it wasn't. It wasn't just a simple download, was it? I was looking at their methodology. They started with over 10,000 targets and had to throw out a huge number of them.
They did, and this is a really critical point. They had to filter out what are called intensity targets.
Can you explain that? What's an intensity target, and why is it no good for this kind of work?
An intensity target is when a company says, we'll reduce emissions per dollar of revenue or per ton of steel we produce. It sounds great, but the problem is you can hit your intensity target and still increase your absolute emissions if the company is growing really fast.
So you get more efficient, but you're just making so much more stuff that your total pollution still goes up.
Exactly. And the atmosphere only cares about absolute tons of carbon. So for a risk model trying to calculate a future carbon tax bill, intensity targets just don't work. You need absolute targets. We will cut X million tons by 2030. Full stop.
So after all that filtering, they end up with about 4,000 targets, which they link to around 1,775 unique public companies. Now that sounds kind of small in the grand scheme of things.
As a number of firms, yes, it's small, but you have to look at who these firms are. These are the giants, the multinationals. They're mostly concentrated in the US, Europe, and Southeast Asia. But here's the really crucial statistic from the paper.
The emissions coverage, I saw that. It's huge.
It's 19.7% of global public equity emissions, almost a fifth. So if this relatively small group of companies actually delivers on their promises, it's not a niche event. It fundamentally changes the risk profile of the entire global market.
Okay, so we've got the baseline, which is the flat line, and we have the target, which is a dot in the future. The paper connects them with what it calls a linear glide path. Now, I have to ask, isn't that a bit too simple? Real progress isn't a straight line. It's lumpy, right?
It's definitely a simplification, and the authors are clear about that. You're right, decarbonization is bumpy, a factory gets a refit, emissions drop overnight, a new technology takes off. But from a modeling point of view, if you try to guess when those bumps will happen, you're just introducing your own biases. A straight line is the most neutral, objective assumption you can make if you accept the starting premise that the target will be met.
So it's not a prediction of how they'll do it, just a mathematical path that gets them there on time.
Exactly. It's a standardized path which lets us compare companies fairly.
Now, you mentioned data can be messy. The paper uses A.P. Møller-Maersk, the shipping giant, as an example of this. They don't just have one simple target, do they?
Oh, it's a web. Maersk is incredibly ambitious, which is fantastic, but they have different targets for different business units, different timeframes, 2030, 2040. If you just added them all up, you'd get a nonsensical number.
So what does the methodology do to handle that kind of complexity?
It finds the center of gravity, essentially. If a company has, say, 3 different targets for the same thing, the model takes the median percentage reduction. It's a way to smooth out the noise without letting one crazy outlier skew the whole projection. It keeps it conservative.
There was another one of those logic checks in there I thought was really smart, the already there rule.
Yes, that's a crucial one. A company might set a target in 2020, but by 2024, they're already way ahead of schedule. The model needs to be smart enough not to punish them for that. It checks if their current emissions are already below the glide path, and if they are, it just uses the lower real-world number.
Right, because otherwise the model would tell them to increase their emissions to get back on the hypothetical line, which is absurd.
Exactly. You always want to give credit for overperformance.
Okay, let's get to the payoff. We have the static business as usual line, and now we have this new downward sloping target trajectory. When you feed that new trajectory into the risk engine to calculate the transition value at risk, what happens?
The change is, it's dramatic. For the companies with ambitious targets, the risk doesn't just go down. It often evaporates. Remember, TVaR is pricing the financial pain of future carbon taxes. If you're on a path to emit less carbon, you're avoiding that future pain. You're insulating your valuation.
The paper circles back to Maersk here. Figure 4 in the paper it's really the whole story in one chart, isn't it?
It's the aha moment for sure.
So under the old static model, Maersk looks really risky. They're a shipping company. They burn a ton of bunker fuel. The model sees a huge future liability. But when you flip the switch to their target trajectory,
their transition value at risk drops to effectively 0 in almost every climate scenario.
0. That seems impossible.
For all practical purposes, yeah.
Right.
The only scenario where they still have some risk is the most extreme, aggressive net zero 2050 pathway. But in the more standard 2-degree or delayed transition scenarios, Maersk's own plan completely neutralizes the financial risk of the transition.
That's a huge shift in thinking.
Yeah.
It means the risk isn't just about what sector you're in. It's not as simple as shipping is bad, tech is good.
Exactly. It moves the conversation from what do you do to where are you going. An ambitious shipping company could be a lower risk investment than a lazy tech company that's letting its data center emissions grow unchecked.
It puts the focus entirely on management's execution.
And that is the real game changer for investors. It means you can find value in so-called dirty sectors. And it's a very big if you believe they can execute on their plan.
Okay, let's pull on that thread. A very big if.
Yeah.
Because this whole model, this whole rosy picture for Maersk, it hinges on one massive assumption. That they actually do what they promised.
And that's the single biggest caveat. The authors are very clear about this. This is a best-case scenario model. It calculates the risk conditional on perfect execution.
And we all know that plans change. CEOs leave, recessions hit, a new technology doesn't pan out.
Of course. And the data itself still has gaps. The paper points out that they couldn't even match about 62% of SBTi targets to reliable emissions data. We're still working with a partial, though significant, picture.
So as an investor, I shouldn't look at this and just think, great, Maersk has 0 risk, I'm all in.
Absolutely not. You should look at this and think, okay, Maersk's risk profile depends almost entirely on execution now. Your focus shifts. You stop worrying about the external risk of carbon taxes, and you start focusing intently on the internal risk of management failure.
It flips the risk from a market risk to an execution risk.
Perfectly put. And assessing execution risk, that's supposed to be what active managers do best. It brings climate analysis back to fundamental analysis.
So let's make this really practical. It's Monday morning, I'm a portfolio manager, and I have this data. I can now see both the worst case static risk and this new best case target risk. How do I actually use that?
The first thing you do is stress test your portfolio. You now have a plausible range. The static number is your risk ceiling. The target number is your risk floor. Your real job is to figure out where between those 2 points the company is most likely to end up.
It basically puts a dollar value on the company's promise.
It does, which leads to the second use, engagement. If you see a company like Maersk where that gap between the floor and ceiling is massive, they should shoot to the top of your engagement list.
Right. I need to get in a room with them and say, look, your whole valuation is riding on this plan. Show me the capital expenditure. Show me the R&D. Prove to me this glide path is real.
You're auditing the promise. And you now know exactly what that promise is worth in dollars and cents. And on the flip side, it also helps you spot the leaders who aren't really leading. You might run the numbers on a company with a target and find that even if they hit it, their transition risk is still high.
How does that work? If they have a target, shouldn't the risk always go down?
Not if the target isn't ambitious enough. If a company says, we'll cut emissions 10% by 2030, but the science says their sector needs a 50% cut to align with Paris, well, they're still going to get hammered by carbon prices. The model exposes that ambition gap.
So just having an SBTi target isn't enough. The slope of that line really, really matters.
The slope of the line is everything.
So to wrap this all up, we've talked about the problem with static models, the marathon runner frozen at the starting line. We've covered the SBTi data, the glide path, and the huge impact this has on risk numbers for leaders like Maersk. But we've also got this big flashing warning sign that this is all based on promises.
It's a new tool for the toolkit. It's not a crystal ball, but it asks a much, much better question.
It feels like the whole perspective shifts from taking a snapshot to watching a film, from accounting for the past to forecasting the future.
That's the perfect way to put it. The future isn't static. The economy is dynamic. Our risk models have to be too. By pricing in these commitments, we get a view of the transition that actually rewards forward-looking strategy.
Before we go, I want to leave our listeners with one final thought to mull over. The model shows what could happen. It quantifies the prize if these companies deliver.
It does. And if I can leave you with one final thought, it's this. For years, the job of the climate investor was to calculate the carbon. Now, this model calculates the financial value of the promise. The investor's job is now to calculate the probability of that promise being kept. How much do you trust that management team? That's where the real work and the real alpha is going to be found.
Thanks for listening to this episode of Emmy's Climate Finance Podcast. Emmy creates climate risk solutions for investors. We provide emissions, transition, and physical risk data for every company and investment supporting 100% portfolio coverage across both private and public markets for all major asset classes. With our comprehensive climate risk data set, we deliver the transparency and customization needed to power investment decisions, meet climate reporting obligations, and align with investor mandates. Emmy is backed by a team of climate and finance experts, and we believe that properly pricing carbon into financial systems is the fastest, most cost-effective way to accelerate decarbonization. To access our latest research and tools, visit emmy.io. We'll see you next time when we explore more climate risk built for investors.